There are 438 federal government agencies. 438. What do we need that many agencies for? We need 7 to 8 max.
Welcome to Retire Smart with David Brooks. I'm Chip Maxwell. Well, David, we have so many things going on now. We just direct our listeners and viewers to retiresmartomaha.com for our events. And there's no charge, there's no obligation to attend our events, but you do need to register. You need to do so online or give us a call, 402-369-7777. I do want to draw attention to one item, David. It's the last call for folks in or near Lincoln for The Psychology of Retirement. This is a movie of which you are an executive producer. Tell us again about The Psychology of Retirement.
Again, great documentary style movie, produced very, very high-end production. Basically, it was paid for by about 100 of me around the country. Independent financial advisors put up the money, which if you've ever tried to produce a movie, and I've done a couple, you can spend money really quickly.
What motivated you to get behind this one?
Well, it's a story that needs to be told. So we love education here. As you know, we do over 80 different educational classes for the public every year here, but we're trying to get this education nationwide, and other like-minded entrepreneurs that are in this financial services spaces all came together. It was actually the vision of a gentleman named Jonathan Musgrave, who's a friend of mine, who basically does a lot of marketing for financial advisors. So that's where he kind of got the idea. And then he went out and sourced the talent. He actually called me, and this is almost 3 years ago, hey, who would be good to be on camera? And I talked, well, David Walker, I know personally, who's the former comptroller. We've had him speak.
Brought him to town a couple of years ago for a September speaker series.
So he's in the movie. Morgan Housel, who writes one of the New York Times bestsellers, he got a couple of them now. His book, The Psychology of Money, which is actually how we changed the name of it. We had a different title for the movie. We changed it once we got him on board. He basically is the host of the movie, if you will, and walks through the stories, et cetera. And he's phenomenal at storytelling, et cetera. By the way, if you have a recent college grad, or a high school grad, buy them that book, The Psychology of Money. It's just 27 chapters, stories about how money really works, how wealth is really created. It's phenomenal. And so I can highly recommend that. But anyway, it's just a great documentary to explain to people the crisis that most Americans face, because most of us are busy day to day and simply have not done the diligent work to be prepared for retirement. How are you going to have income when you're stopped working? And without income, there is no retirement. So we're going to be showing this multiple times, both in Lincoln and in Omaha over the next year and a half or so.
We've had a couple screenings in the Omaha area, but the next one, it's coming right up Monday, October 28th. So get your dialing finger going, 402-369-7777 if you want to join us. The Edgewood Cinema in Lincoln, Monday night, October 28th, 6:30 p.m. We'd love to see you there. There's no charge, there's no obligation, but you do need to register. Do it online or give us a call. We'd love to see you Monday night, October 28th at the Edgewood Cinema in Lincoln. Well, David, into the news we go. You mentioned that crises people face. There is a crisis brewing. You've been talking about this for the better part of a year in the banking industry. Here's a headline from Cryptopolitan. U.S. banks' unrealized losses soar to 7 times 2008 crisis levels. Well, so a chill runs down my spine when I see a reference to 2008. We all know how bad things got economically, 07, 08, 09, and in the wake of that. 7 times worse. What's going on, David?
All right, so first let's go back to that time period. You had over 50 banks go under. But the asset total of those 50 banks in the 08-09 that went under were less than the 3 main banks that went under just 2 years ago, Silicon Valley Bank being the biggest and the first that went down. Well, just this past weekend, we had a bank just south of us in Lindsay, Oklahoma, go under, and the Fed comes in and takes them over on a Friday. Just so you understand, if you're under the deposit limits, the FDIC insures your money, et cetera. But we can expect several more of these to happen. And when I sent that article out, which is almost a week old now, I kind of was telling you guys, look, Treasury, every time Treasury rates go up 10 basis points, it's probably another bank failing. Well, Treasury rates have gone up 15 basis points since I sent you the article. We crossed over, as of this recording, we're now over 4.25 yield on the 10-year Treasury. The higher that yield goes, and if you remember, when Treasury yields went up a couple of years ago and the Fed started raising, that's what created the banks to fail. Because what happens, Chip, is, and we've got a chart to show how much unrealized losses are sitting on the major banks in the U.S. today, and it's 7 times, as you mentioned, 7 times larger than the losses occurred during the
Let
Great
me ask
Depression.
you to define a term
Great
here.
Recession, excuse me.
What is an unrealized loss?
All right, so if they were to sell the asset, they would lose money. Just like if you own a stock and you're down, you have a loss, but it's a paper loss until you actually sell the asset, right? So it's not a real loss until they actually sell it. So, of course, then the argument is, well, then they'll just hold it to maturity. Well, that'd be great, Chip, if they could. But you got to understand the way banks actually work. They make money off what's called net margin spread, right? So they take your money. They don't stick it in the vault and wait for you to come and ask for it because they wouldn't make any money if it's just sitting on the vault floor.
Well, they're putting it out there and using it.
So
It's
they're
putting it in
buying
play.
assets, they're making loans. So these assets, which are typically loans, are what's underwater now. And it's heavily in the commercial real estate space. As we know, commercial real estate, and we've talked about it for the last 2 years, all the buildings that are selling for 10 or 15 cents on the dollar. So the value of the loans are significantly handicapped. And again, if they hold to maturity and the person they lent the money to has the ability to pay, then all things are good. But what happens if you say, you know what, I'm cashing out my $500,000 in CDs at your bank, I want my money. I want to tell you, there's very few branches you can walk into that have $500,000 in the facility. Most this might shock people, have less than $100,000 cash in them. Most banks that are on the brick and mortar have less than $100,000 of actual cash in any one location.
I'm seeing a vision of It's a Wonderful Life in my mind.
Exactly what's going to happen.
Building and loan. We don't have all of your money just stacked up here. It's in Joe's house,
Betty's house, Joe's house, et cetera.
Yeah.
And that's exactly what happens. So if you go and if a run starts on the banks, and again, we already had one, which happened during the last, people get nervous and go pull it out. And we've seen it. We've seen over $30 million from our clients take it out of banks and then give it to us to guarantee interest rates for longer terms than they were getting at the bank. And they had us buy T-bills. Some of them bought guaranteed fixed annuities with interest rates backed by the insurance carrier. So we've seen people make that move over the last couple of years. And imagine that across the entire country. We're just one small financial advisory shop in Omaha, Nebraska. So multiply that across the entire landscape. If people get nervous and Treasury will keep going up and you're not getting paid anything in the bank, what are you going to do with your cash? If you're blessed to have it, you're going to move it where you're going to get paid. And by the way, we can still pay you 4.35 interest, on your money by the money market FDIC insured up to $5 million every day. So if you're not getting that at least, then you want to find out, you can reach out to us. But anyway, the problem is there's going to be more bank failures. And on top of that, and I think I sent it to you, and I don't know where we may cover it later in the show, but a couple of the biggest investors out there in hedge fund land have now shorted the Treasury market to vast numbers. So Stanley Druckenmiller is now 20% of his entire portfolio is short.
We have a question about that in our Q&A today.
Okay, so I'll save it and talk about it there, but I'm telling you where the smart money is going is telling you that interest rates are going higher in the near term, not lower. And again, that comes back to inflation. The bond market is kind of sticking their tongue out at the Federal Reserve, who tried to influence rates going down. I mean, that just brings up another simple discussion. Does the Federal Reserve control interest rates? The answer is simple, no. The Federal Reserve controls the Fed funds rate, which is the overnight rate you pay to balance your books at a bank when you go to the Fed window, because you have to balance every day, which is, by the way, why banks used to have to close at 2 p.m. because they had to tally everything up every day. You had to have your books reconciled by the end of the business day. So now if there's an imbalance, they simply are allowed to borrow at the Fed to kind of make their balance sheet work every day, and these transactions happen daily. Now we're actually paying banks to deposit money at the Fed, which the Fed is losing money. We talked about that on the show recently. So the Fed's losing an astronomical amount of money, but the Fed can influence rates. So they lower the Fed funds rate, lowers the discount rate. So that has usually an immediate impact on banks for credit cards, right? So those are the rates that they can change. Money market rates, short-term signature loans, even HELOCs. But the further you go out on the length of a loan, the less influence the Fed has. In other words, if you were to borrow an 84-month car payment, it's going to have some effect on the car loans rate, but nowhere near as much as if you were on a credit card, which is every month, right? So it can change. Then you look at a mortgage, a 30-year mortgage. Yes, it affects it, but very little. And so the further you go out on the duration of the financial instrument, the less effect the Fed can control it. And the 10 years, what we base most of financial instruments off of today, mortgages, et cetera. It used to be 20 and 30 years, but really the 10 years really what we watch. And again, that has gone up. We've seen mortgages go over 7%. The Fed cut 50 basis points. Everyone thought it would be down 100 basis points. Instead, it's up 100 basis points for these kind of lending products. That is telling you inflation has not been covered. They have not finished the job, and it's going to put them in a rough spot because now with their dual mandate, As unemployment starts to rise, with inflation rising, what do? And they have egg on their face, and they're in a really tough spot. And we'll talk about it again later, because I think you said we have a question about it, but I can show you where the big money's betting.
There's pressure on the Fed. There's pressure in the banking industry. That's why we monitor all of these things, because ultimately they can affect the economy, they can affect the markets, they can affect your portfolio, your standard of living in retirement. That's why we monitor all of this. Feel free to take advantage of that process and get what we call a report card. Up next, we take a deep dive into fiscal policy, specifically debt. What are the current numbers? Is it a problem? Can it affect your retirement? Stay tuned for the answers. You're listening to Retire Smart with David Brooks. Welcome back to Retire Smart with David Brooks. I'm Chip Maxwell. Well, David, the numbers are sometimes mind-numbing, I guess, but every once in a while we've got to stop, take stock, see where we are and where we're going or where we don't want to go. And you sent me this. The headline is, U.S. deficit tops $1.8 trillion in 2024 as interest on debt surpasses trillion-dollar mark. So the interest on the debt, one line item in the budget, is now north of $1 trillion. The deficit itself is almost $2 trillion. What are we spending now? $6 or $7 trillion a year? I'm losing track myself. Where are we fiscally?
For this next 12 months, they're going to spend $7.8 trillion.
but we only take in, what, about $4 or $5 trillion?
Yeah, we're estimated taking about $5.2 trillion in the coming 12 months.
Well, that's where you get the $1.8
yeah.
trillion
and
deficit,
so it's just getting crazy scary here. So you can't just spend your way out of a problem or a crisis, et cetera. And we've just gone bonkers. So the Treasury every month reports how much debt they add every month. And remember, we had a questioner, one of our listeners called in and said, "Oh, you meant, $2 billion a day, didn't you?" that we add to the debt. And I'm like, where do you hear these numbers, buddy?
Yeah. Yeah.
So on October 11th, the Federal Reserve's website was supposed to release what they had for September's debt. They just took it down and changed it. I will release that next week. They literally moved it out because they wanted to get it off a news cycle and released it on a Saturday and 10 days late. Yeah. And it turns out it was $510 billion added that month. $500 billion was added basically in 3 weeks. I mean, this is insanity. And so, and there's a chart. I've got a chart right from Bloomberg that tracks this every day that shows that jump in the debt. And it's so hard for people to understand, because it sounds like plain numbers. It just makes no sense. But we've seen countries, Venezuela, Zimbabwe, we've seen countries go down this road where they just start overspending because nobody stops them to try and maintain power control, et cetera, in a moment in time. And it always ends badly. And we are now at a precipice that you cannot get this genie back in the bottle. Our defense spending, Chip, is less than $900 billion. $894 billion, I think, is the budget number for this next year. We're now at 1.1 to 1.3 trillion in interest payments. By the way, that's over $3,900 for every American every year. Well, that just interest payment. That is not, you're not paying any principal, but that's what each American owes just if we were to maintain paying interest on our debt.
Well, and you noted, so right now that's about a quarter of our revenue is going to it, and we're on pace to get up to about 30% of all of our government revenue is going to have to go to just paying interest on the debt, never mind paying off the dead.
Well, to kind of quote one of my favorite economists, Brian Westbury, we talk about him often. He from First Trust Portfolios. So he had put out a tweet earlier in the week. Federal spending fiscal year 23 was $6.13 trillion. Federal spending fiscal year 24, which just ended in September, was $6.75 trillion. That's an increase of over 10%. GDP was up 5.7%, which we had the administration bragging on. So you spend 10% to get 5.7. Is that a good investment? Is that a good ROI on your money?
Multiplier going the wrong direction.
And so for these people that, let's just call it, maybe have low IQs that think, oh, the government spending is fueling the economy. That's not fueling the economy. That's negative, right?
Well, a lot of people on Capitol Hill of both parties will say, well, we're investing in the country when they talk about spending. But as you say, well, what's the ROI?
Please let me know where the government has invested money where we've made anything more efficient. Just name one example. I'd love to hear it.
Right before we sat down to do this show, David, you sent around to the team a chart of how 200 plus years we managed to avoid this kind of fiscal calamity. And just in the last decade or so, I think I see that chart appearing now.
So the chart shows you the first 221 years we existed, we ended up totaling about 12 trillion in debt. Now, just the last, since 2020, we've added 12 trillion. Now, we added another almost 12 trillion in between those two boxes that are on the screen. We're now at $35.8 trillion. But we have gone, as I said, parabolic these last 4 years or so, and it's unsustainable. And so either we have to have a big reconciliation where tax rates are going to go up. And according to the Wharton School of Finance and Stanford University have both studied this, and the CBO, tax rates across the board are going up 40% by 2030, across the board. Doesn't matter what income bracket you are. And that would only maintain interest payments, not pay our budget. We'd still be running a deficit, by the way. So we have to get serious. And again, we know this is the election, right? Is less than 2 weeks away, right? We're about 8-9 days away from the election here. So, the one thing, like my wife is like, I don't trust Elon Musk or whatever. She's skeptical of everybody, as you know. But obviously he's chosen a side this election for sure and is taking some heat from the other side. Then you have the billionaire Mark Cuban, who's decided to take the exact opposite stance. It's kind of funny, what's going on here. But what I love is the efficiency you've seen him deliver in the auto industry, right? The manufacturing cost.
About Musk now.
Yeah, Elon Musk in Tesla. What he's done in the space race, right? From what Boeing would spend on government contracts to what SpaceX spends they've cut the expenditures of getting cargo to space, not by 30%, 1/30th of the cost of where it was 10 years ago. 1/30th of the cost. That's efficiency when you throw the government the heck out of the way and question everything, as he has his idiot algorithm. Why does the rule say that? Then go find out who wrote the rule and prove to me that rule needs to be there. Like why there's 4 screws instead of 3, et cetera. But I mean, by the way, his Walter Isaacson biography is one of the best books you can read if you like to read biographies. It's really well done. But anyway. So he is volunteered to potentially be, we'll call it the czar of government efficiency. And that makes me get excited, which is why I'm telling you on the air, I'm voting for Trump because he's a one-term president. I could use less of his rhetoric for sure. But I'm looking for a Javier Milei style term here where we go in and rip it out.
Argentina.
There are 438 federal government agencies. 438. What do we need that many agencies for? We need 7 to 8 max.
Somebody, I think it was Kevin O'Leary, maybe one of the names and faces in the financial world out there, who was just chuckling saying, oh, that's one reason I'd love to see Trump win. I want to see him just let Elon Musk loose on the federal bureaucracy.
Absolutely.
And tear into it. And well, David, we've been talking about the macro level now on debt. Let's take it down to the micro level. Let's take it down to the grassroots level where people live and work and are trying to pay their bills and so forth. You sent me this story from Fox Business. It's about a study done by the New York Federal Reserve. American consumers see debt delinquency risk rising, higher long-term inflation. So what I took from that story was people don't seem to be so afraid of losing their jobs as they were in recent years, but they're worried about the relentless pressure of inflation and then maybe defaulting on certain debts.
What was interesting, too, is, and it's another study referencing, but it's the same type of research, 73% of those employees are looking for new jobs. 73% of American employees are considering taking a new job. In other words, I know we just onboarded a couple new employees here, and how do we get them? I always say to find A players, they usually already have a job. So most of the people we hire are typically already working somewhere else. So that's what we go search for. We got to try to find somebody who's doing what we want them to do in another location, and maybe we can offer them a better deal to come do it for us, more efficient, and give them a growth and opportunity to grow their career. But Americans are frustrated, so they're nervous. They're looking for jobs because job cuts are mounting. But as you said, this story focused on, well, how are you feeling on the economic side of things? And they're very worried about being able to pay their bills. 26.83%. That's what true inflation says you're up in the last 4 years since this administration's been in the office to pay for household items, right? Your car insurance, your homeowner's insurance, your grocery bill, your car loan, the things you have to pay just to function, to daycare, to take your kids if you have them, et cetera. 26%. So that means your paycheck has shrunk by 74%, your take-home pay. Right? It's very simple. So I don't know many companies that have given people 26% raises over the last 4 years. You could not stay in business as an operator. So people, that's where they're nervous. And as I mentioned, we're seeing inflation rear its ugly head again and starting to reaccelerate. I think you're going to see CPI. So I'll go out on record here. I think it's going to be about 2.58%.
Consumer Price Index.
Yeah, as we report that here coming up at the end of the month. We're going to see how accurate I am, so you can document that. 258 is my number. But expectations out there, consensus is around 2.3. So if I'm right, and we're 2/10 hot, that's a big, big problem. And we'll continue to accelerate in north of 4% probably by February. But anyway, that's because we read data here, and nobody likes to read data for some reason I don't know on the talking head shows. But anyway, it's a problem. The consumers are right to feel anxious because their paycheck is getting eroded. And again, we always talk about politics here. People are like, why do you talk politics? Well, because we care. The legislative changes are going to have consequences. And so I'll challenge anybody out there to tell me why you're voting for who you're voting for from an economic standpoint. What is this going to mean for your family over the next 4? And by the way, whoever wins, they're going to face a mighty, mighty big recession. We have some serious economic problems to face in the next couple of years.
Up next, you have questions. David Brooks has answers. Q&A is next on Retire Smart with David Brooks. Welcome back to Retire Smart with David Brooks. I'm Chip Maxwell. Into the Q&A we go, David. Our first question this week is from someone we know affectionately as Rotten Ralph, a client. I caught you in mid-swallow there.
Yeah. I love Rotten Ralph.
Well, actually, he hung that moniker on himself. The truth is he's a sweetheart of a guy. But anyway, Ralph has a question about tax policy. And so here it is. Competent sources at Fox Business said a Harris victory and the proposed tax increases along with it will send the U.S. into a 1930s-style depression. What do you think?
Well, some of the things she's proposed, I'd have to agree with it. Now, the reality is, can those things actually get enacted?
We're back to our conversation from the first segment, the second segment, the Bailey savings and loan runs on the banks and so forth.
So some of her proposals that they were talking about on Fox were the tax on unrealized capital gains. Yeah, we'd be in a depression with almost immediately after 1 year, fiscal year, because you have to pay tax on your family farm, the value that it went up, right? So let's say you have a farm that's worth $10,000 an acre and you own 640 acres. That's a $6.4 million family asset. You may have had 5 generations in your family, but what happens? Acreage went to $12,000 an acre based on valuations, recent sales, et cetera. Now we have to revalue your farm at another $1.28 million. So instead of being $6.4 million, now your farm's worth almost $8 million. You would have to pay a tax on that unrealized gain. And under her original proposal, capital gains rate you would pay would be your income bracket, which would automatically put you at 39.6%, at least under what's on the books today. So 40% of that $1.2 million of the gain, the family farmer, where are they going to come up with the $400,000+ to pay that tax bill? They'd have to sell the asset. Yeah. So it's ludicrous to think that that's something that they would do. But I thought it was ludicrous for the AMT tax, which, by the way, is coming back in less than 13 months. So I paid it.
The what tax?
AMT, Alternative Minimum Tax. This was one of those crazy taxes they enacted, literally to tax, if you study history, 236 families. This tax was created to tax 236 families specifically were targeted with this tax. And it taxed over 4.7 million tax filers in 2017, moi included. All right. Trump's tax bill pushed the exemption limit through the roof, so very few people have to pay the AMT tax today. That comes back when the tax cuts expire at the end of next year. So millions of people are not prepared to pay an additional tax on top of the higher marginal tax rates they are going to have to pay with the lower standard deduction. I mean, we're going to spend a lot of time next year explaining those changes coming because a lot of people are going to be caught off guard. But to Rotten Ralph's question, yes, if everything she originally proposed were enacted, yes, we'd be in a Great Depression. Now, here's the sadly, doesn't matter if Trump wins or Harris wins, we are going through a Great Recession, most likely. We are going to have problems. I showed you all the problems with the banks, the assets, et cetera. And if you decide to go pull your cash out of the bank because interest rates are going up and you can get 4 or 5% somewhere other than sitting in your savings account, your passbook savings, your checkbook, or your CD, we like to refer that to as, of course, not a certificate of deposit, but sometimes a certificate of disappointment, because you're typically not keeping up with inflation and taxation. So you're actually losing, you're getting less than a positive nominal rate of return. So yeah, it's a problem, Ralph, and I'd be happy to discuss more. Now, here's the thing. I don't want to speculate and spend too much airtime on it, because in 10 days we're going to know. Well, we're going to know the election's over. We may not know the outcome. We have each state now rolling out. It seems the swing states that have blue governors like, Arizona just said it might be 2 weeks before we can give you results. I think that has to get through, that you must report the day of. But anyway, so I don't want to spend too much more time, Ralph, but we'll cover this extensively once we see the outcome and the makeup of the Senate and the House, which is really what's important, which, just so you know, as of today, is almost a 40% chance of a Republican sweep where they'd win everything. There's only about a 14% probability as of today, and this is from Polymarket, by the way, that the Democrats get a sweep, and that's where she could enact all that. So less than 1 in 8 chance that comes to fruition as of today.
Next question, David, is about Treasury bonds. The question is, have you seen what Stanley Druckenmiller is doing with Treasury bonds? What do you make of it? Well, you made a brief reference to this earlier in the show, and I think we have something from Motley Fool that you found that references
so there was
Stanley
an article.
Druckenmiller is getting people's attention. Why?
Yeah. All right, so Stanley Druckenmiller is a legendary investor, runs a large pool of money. He's one of the original kind of Wall Street legends, at least from the last 40 years, and he is literally short 20% of his portfolio. He has gone actively short on the U.S. Treasury.
Okay, what does that mean to say he is short?
So he's when the old adage, when you're looking to make money, you buy an asset low, you sell high. Buy low, sell high. When you short an asset, you just do it in reverse order. You sell high and hopefully buy it back lower. And you have to borrow to do this, but you can do it. And it's not for the faint of heart, by the way. But he's betting that Treasury yields are going to double effectively. So, and you had actually sent me a question when I kind of found the article, when you said, hey, I think we're going to have a question on this, and I sent you the article, and then you're like, what do you mean rates double? What rate? Yeah. And I was telling you the 10-year Treasury was sitting at about 3.43, so under 3.5% a couple of weeks ago, right, as the Fed made its move. And it is now sitting above 4.25. So it's already moved 75 basis points, which means the Treasury yields, and the easiest way to track this is you can look at ETF tickers like AGG, which is the Aggregate Bond Index, or TLT, which is the iShares, the BlackRock's. It's the most popular ETF out there to buy Treasuries with. It's down in value, and so it goes down. When rates go up, bonds value go down. So he's betting that those values will go down, and he's going to make a profit. So every time the interest rate goes up, he's making money. On top of this, it's not just him. And this is not a small bet, Chip. Like when you asset allocate to risky assets or risky bets, typically 2 to 3% of an overall portfolio you'd have, 20 or 30 things you're invested in would be in one individual investment with a max of 5 to 10%. 20% of his entire portfolio is making this bet. That's a huge amount of money, and that's pretty heavy conviction, I would say. Now, on top of this...
Is he right?
I think he is. Rates are going higher, absolutely.
I mean, you've been saying for weeks and months, the Federal Reserve can make pronouncements, but look at the bond market. That'll really tell you what reality is. So and maybe this is a case study right here.
Yeah, so we have Paul Tudor Jones, another heavyweight.
A big hedge fund manager?
Yeah, runs a hedge fund. Same thing. He's shorting treasuries, and he's actively telling you what's coming. And so you're starting to see the billionaires line up and make their bets that treasury rates are going to have to go higher in the next 6 months, not lower. And again, even one of our advisors just bought a new home, and he thought that after the Fed started cutting, he'd get a lower mortgage rate. He's literally locking in his mortgage this week. He has to close. And I'm just like, well, you're going to have to grin and bear it for a little while, buddy, because those mortgage rates have gone up.
We just talked about that last week or the week before on this show.
Yeah. So, so this is unfortunately not good for the economy, Chip. It's real simple. If rates are higher and you're needing to borrow money, whether that's on a credit card to pay those day-to-day expenses like the bottom half of Americans' income earners, or you're simply trying to borrow money for a business opportunity or to close on your first home, whatever it may be, you're paying a higher rate, which means more cash flow has to go out every month to debt service, just like our government, ironically, right? We're spending way more on debt service, and so you have less money to spend in the economy. On top of that, Chip, all those dollars, that $35 trillion in debt we're talking about, $15 trillion of that is rolling in the next 18 months, and it's going to re-rolling at a higher rate than, and even the Fed was just projecting, which means the deficit projections of the CBO and everybody are absolutely wrong. So again, it does not look good regardless of the political outcome here unless we really start slashing government spending. And again, we need a Javier moment.
Javier Milei of Argentina. Hey, listen, Mr. Financial Advisor, I want to squeeze this in. I'm only going to give you about a minute, but I think it involves me. So I definitely want to hear the answer to this question. It's about a 401k. I read a news article about proposed changes allowing people to put more into their 401ks, but there was a lot packed into the article. Would you take a look at it and tell us what you think the main takeaways are?
Okay, so basically, when you're allowed to contribute money into a 401k, and again, we should always talk to people, should they defer it into the tax-deferred bucket, which is what became really popular, but for most people is the wrong answer because you're going to be a higher tax rate in the future, not lower.
Take the hit now on taxes, and then the money grows tax-free.
But you can defer basically up to a cap. 23,500 will be, I think, the number next year. And forgive me if I'm wrong on the number. I haven't looked at the exact number. But basically, you can put a chunk of money away. When you're over 50, we've had what's called the catch-up contribution around for a long time. Unfortunately, you and I meet that criteria. So we get to put another chunk of dollars in there, right? Now there's going to be a senior catch-up contribution of an additional $10,000 on top of that when you're between 60 and 65. So basically...
I'm grinning because that's me, but not you. Sorry.
Yeah, so you'll be able to put even more money into those accounts.
Okay, that's what
and again, the idea behind this is that people need to save more, especially as they're getting really close to retirement, those that need to catch up. So from that standpoint, it's good because if you're disciplined, this will automatically do it. The problem is, again, the average person that's over 60 now, the median income in America is less than $65,000. And so are they going to be able to put half their income away, right? And probably not. But it's great for those that have the ability and don't need the income and want to defer it. And again, you should talk with a financial professional if you should be sticking that in the tax-free side, the Roth side, paying the tax bill now, but you could put more money away. So yeah, Chip, next year you'll be able to sock some more money away.
Looking forward to that. Up next, the markets seem to have priced in another rate cut by the Federal Reserve next month, but economist Ed Yardeni says no more rate cuts are coming. We'll explore that next on Retire Smart with David Brooks. Welcome back to Retire Smart with David Brooks. I'm Chip Maxwell. David, we are going to get to Dr. Ed Yardeni's comments and observations, but first I just want to note, because we've been following, we sort of have this running theme, this running topic, this economics 101 point that if a state makes it impossible, unprofitable for a business to operate, the business is going to pull up stakes and leave. And you sent me this story from Fox Business. California oil refinery announces closure after Newsom, that's Governor Gavin Newsom, signs more regulations. This is Phillips 66, closing a refinery in the LA area. But it's, as I say, it's economics 101. Eventually, you make it impossible for the business to do business. It's going to leave.
Absolutely. I mean, it's really simple. Those that have the ability will up and transplant, just like states. I mean, we've had so many entrepreneurs leave certain states. I mean, we had mass exodus out of Michigan, New York, New Jersey, and they headed to, in California, to states that were either tax friendly, like Nevada, Texas, Tennessee, Florida, et cetera. So they're moving where liberties are not infringed on, or they have a better tax environment. South Carolina was a big net benefiter of the last couple of years. So we're seeing people move, and not only themselves, right? But now you're seeing companies have to make these tough decisions. Again, we talked about Elon Musk a little bit earlier. Same thing. He's moved most of his companies out of California and continues to do so because they just want to, all they want to do is punish companies and overregulate them and overtax them and put these burdens to create behavior. But again, if they have the ability to leave, they're going to leave. And that's exactly what happens. So the problem here is now those jobs are lost. Those are high-paying jobs. Oil refineries, oil workers that work at refineries are very well-compensated employees. All those jobs are leaving. And on top of that, now you have to transport that oil back in to replace what was locally delivered, right? The end product. Therefore, there's more transportation costs, more labor costs. So guess what you're going to do in California? What's going to happen to the price of gas at the pump?
No, you're going to lose all the way around on this deal.
So again, this is just idiots at the helm. Legislative people don't think through unintended consequences. I understand they want to have certain behaviors, et cetera, but this is not the way you do it.
All right, David, I had never heard of Ed Yardeni until you sent me a couple items featuring him. I found out he's got 96,000 followers on LinkedIn, I think it was.
Oh, he's a Wall Street legend. I mean, I've followed him for my entire career. So,
all right. Well, thank you for expanding my horizons here, and it now includes Dr. Ed Yardeni. And the first item I want to look at is famed economist Ed Yardeni's updated his Fed cut prediction to none and done, because the inflation battle isn't over. I thought the consensus of the financial world, David, was that next month in November, the Fed's going to meet and there's going to be another 25 basis point cut. But Yardeni's having none of that.
If you just go back 3 weeks ago, Chip, the futures market, which kind of tells everything, the futures market was betting there was a 35% chance of a 50 basis point cut coming in November. Another 50 basis point cut coming, and then 25 in December, right? That number dropped down to 12% about a week ago, an 87% chance of a single cut. Now it's 50-50 if they'll do a single cut. And I'm with Ed. I'm telling you, because of the CPI that I predicted will come out and the jobs numbers, they will not be able to cut rates. Now, if they do, it is 100% simply they're trying to lower the cost of their refinancing, but the bond market is going to say, not buying it, which means, just so you know, you're going to have Janet Yellen get crafty and keep rolling debt on very short-term instruments and pay higher interest rate until they can get longer-term rates down and then refinance that debt. And that's a trick they've been doing for the last 24 months. In other words, they should be refinancing debt typically at 10-year and 20-year, 30-year denominations. They've been refinancing 70% of what normally would have gone to those durations to 2 years and less, because they were trying to wait until they got rates down, and they're trying to sell you this story. So again, Fed's got a problem. We'll see how it works out.
Well, okay. So let me try to connect that back to Stanley Druckenmiller. Is that good or bad for Druckenmiller's play if there is no Fed rate cut next month?
That's good for his play, right? And that's exactly, so you're seeing the big money lineup, the smart money lineup. Yeah. And by the way, I always tell you, we always talk about smart money. Of course, there was the movie Dumb Money we've referenced on here, and I think there's a sequel now coming, but Dumber Money, I don't know. But anyway, okay. The bond market is about 700 times larger than the equity market. Take that in, 700 times larger when you look at all the different products offered through the fixed income side of the market. So way more dollars are betting on the bond market than on the stock market in any given day. When I started, we had almost 9,800 publicly traded companies on the New York Stock Exchange alone, let alone the NASDAQ, the American Stock Exchange, the Philly Stock Exchange, et cetera. Here in the U.S., there was 12,000 publicly traded companies. Today, there's less than 5,000 publicly traded companies, right? Yet you have 17,000 mutual funds chasing 4,800 companies. But anyway, so there's way more money in the bond market, and the bond market, when it for smart investors, if you watch what the yields do, that's what I had a call on the way in, Chip, with a very good friend of mine who's been a long-term self-trader. I mean, he's independently wealthy guy, and all I always tell him is, what's the 10-year yield doing? What's the 10-year? And that just tells you everything you need to know where you need to look next. It's the first thing I look at every morning. What is the 10-year yield? That's the first place I go, because that gives us a hint and direction of what's going to happen in the broader market. And again, this is telling you that inflation has not been squashed. And again, the ugly word, we've talked about it for weeks, stagflation, it's here, right? So if inflation's rearing its head and growth isn't happening.
Economic growth.
Correct. Yeah. And again, if we spent 10% more on our federal budget to get 5% growth, that's not growth. That's negative 4.3% nominal growth for our government spend. That is a terrible ROI. And again, how many people out there in listening to our show right now are getting a negative ROA? In other words, your job with your hard-earned capital, and I'm not talking about your investment, I'm talking about your savings, your savings account, your money market, your CD. If you're not beating taxes and inflation combined with the return on those dollars,
you're losing.
You're going backwards. And because, like I said, 26% inflation in the last 4 years, on your cost of goods and services, a CD that was paying you even 4%, you lost by 10%.
Yeah. I tell you, it happens in the financial world. It happens in the political world. I don't care what conventional wisdom says. When I see names like Ed Yardeni and Paul Tudor Jones and Stanley Druckenmiller lining up over here instead of over there, then I take notice. We may have a new consensus forming here. David, let's conclude with another item you sent me this is from Yardeni's own research operation. And the headline of the study is, "Why aren't consumers happier?" And it starts by noting the misery index, the combination of unemployment and inflation, is relatively good right now. And so what is the answer to the question posed by the study, David? Why aren't consumers happier?
Well, if the misery index is higher than the Fed funds rate, that's usually bad news, right?
Okay.
And exactly. So unemployment rate plus that. And so these are things we can watch, the misery index, and determine if people are happy. And again, we talked about an article, I can't remember where it was. It was one of the left-leaning national papers. But remember, you're doing better than you think or something.
Yeah.
I remember.
How dare you be upset?
Yeah, dare you be upset.
Yeah.
And here's the reality is, again, because the talking heads and the politicians don't study economics, they think because inflation is being reported at, say, 3%, 3.2%, hey, inflation's down, you're paying less. I mean, there's literally been politicians on the trail this season saying you're paying less than you were last year. No, sorry, that's not how it works. Very ignorant people. You're paying 3% more than you were 12 months ago, if that's where inflation is. But you have to stack the last 4 years. And again, Trueflation's a great website to go to find out what the real cost is to the average consumer of what it is, and it's about 26% for all your household goods. I was at Hy-Vee grocery store last night with my son because he had a wild hair. He wanted to make a certain dish, which was awesome. He made me dinner last night. I'll take that any chance I get. Yeah. But we went in there to buy ingredients for one dinner, and now he likes a couple of little add-ons in the cart, but I mean, we'll have leftovers. But it was $109 to walk out of Hy-Vee what I bought.
Goodness.
And I'm like, wait a minute, what is the now? There's multiple things there. We can make this same meal probably 5 times over, but still, this was not a grand meal, but it was one he likes to make, and it was pretty good. But that's the kind of inflation. I mean, it used to be $109. You'd fill your grocery cart. Now you get like 3 little plastic bags, and that's all you walk out with. So that is what the American consumer is facing right now, Chip. And they are starting to fight back and say, no, I'm sorry. And again, we're seeing this in the political polls. People are like, I'm just not better off than I was. And we're seeing this in some of the historical voter blocks that may vote for one side or the other are shifting or changing sides because of what's happening to their checkbook every month. And again, this is a problem. You cannot bless or gift to people free stuff like the student living, student loan forgiveness. Now there's, hey, if you start a business, and then Kamala recently, VP Kamala Harris wants to give $20,000 only to black male entrepreneurs, and sadly, she had the audacity to say so they can open a weed shop. She literally how about
that got kind of weird.
Yeah, why couldn't you open an IT shop? Why are you pigeonholing? And anyway, it was really a weird interview. But if you didn't watch that, but you can't. She's buying votes is all she's trying to do, and none of this is constitutional. And the problem is you can't just give people things that creates inflation because where are you getting the money?
Well, so that's ultimately the answer to the question: why aren't consumers happier? Because they're
inflation.
Still feeling the
bottom
pain of
line. Inflation.
All right. That'll do it for this week, friends. Please visit our events page at retiresmartomaha.com to see everything we currently offer. No charge, no obligation for our events, but you do need to register. And don't forget, last call for The Psychology of Retirement, a movie on the challenges retirees face today. One of the executive producers is our own David Brooks. 6:30 p.m. Monday, October 28th. At the Edgewood Cinema in Lincoln. We'd love to see you there. You need to register. Do it on the website or give us a call at 402-369-7777. David, bring us home.
Have a blessed and prosperous week.
Thank you for listening to Retire Smart with David Brooks. I'm Chip Maxwell. For David Brooks and the entire team at Retire Smart, have a great week.